Good afternoon and welcome to our webinar today. I'm Sophie Lewis, Marketing Executive at Equitech, and today Ramone Param, one of our Associate Directors, is going to be talking to you about which buyer could be best for you and how best to attract them. We're going to be doing a bit of a presentation followed by our usual Q&A session at the end. So if you have any questions, please use the control panel and you'll find the Q&A box on the right-hand side. Over to you, Ramone.
Thanks, Sophie. Hi, everyone. So my name is Ramone Param. I'm an Associate Director in the Market Intelligence and Buyer Coverage team based in Equitech's New York office. A bit of background on myself. I started my career with Macquarie Group's corporate finance business based in London, and I subsequently joined PwC's corporate finance business, where I was a founding member of the Accounting Network's global corporate development team. And in that capacity, I advised the global leadership team at the firm on their inorganic growth strategies, really focused around consulting M&A. And that included advising PwC on the transformational acquisition they made of Booz & Co., now known as Strategy and also PRTM in the US. So today's webinar will be about 40 minutes. It will be covering the differences between the two main buyer groups, private equity and strategic buyers, discussing some of the positives and negatives of both types of acquirers for you as a consulting owner at different stages in a sale process. And then we will finish off with some questions and answers at the end. And the presentation is really based on our experience and knowledge of consulting buyers through our regular dialogue in the market with these firms, as well as our thought leadership, including our annual M&A report and our annually commissioned buyers survey, which provides us with a very unique insight into the market and a lot of very unique data points that we can use in understanding what's going on in the space. So with that context, let's kick off with an overview of who the two main types of buyers of consulting firms are. So we firstly have strategic buyers, commonly known as trade or corporate buyers. Now, strategic buyers have existing companies, very much like your own, and they typically make acquisitions which form part of their own existing operations. So the buyers here are looking to enable revenue growth synergies as part of an acquisition of a consulting firm. And we also have private equity, also known as financial buyers, and these are investment firms investing private capital into businesses. They typically leverage businesses with debt, then hold that investment for a period of time, normally about 3 to 5 years, during which time they're growing the company really with the aim of selling it at a profit, either to another private equity firm or a strategic buyer, or undertaking an initial public offering where they will float the company on the stock market. Now, private equity buyers like consulting firms that demonstrate, standalone growth, stability, and high profit margins. So they'll be looking for that in contrast to the synergy opportunities that a strategic buyer will be looking for. Now, the majority of deals in the market are undertaken by strategic buyers. And over the last 5 years, the accounting networks have been highly acquisitive strategic acquirers in the consulting space. But more recently, we've seen deal activity and pricing rise amongst listed trade players. So you might have seen in our latest Q3 market update, we highlighted Accenture as having done 7 deals across the consulting sector just in the last quarter alone. And in last year's annual M&A report, we highlighted prolific buyers across the knowledge-intensive services space, many of which were quoted trade players. Now, as we can see from the right-hand side of this slide, a lot of these trade players have been benefiting from rising share prices, substantial cash balances on their balance sheet, and also rising quoted valuation metrics, which really enables them to be competitive on pricing while still being able to make earnings accretive acquisitions. Now, moving on to private equity, the consulting sector has historically been challenging for some private equities to get their heads around, and their involvement in the space has been cyclical. But there now are many private equity investors that have really figured out the space, and they're continuing to be active acquirers in the industry. A more recent trend that we've noticed is that private equity investors that invest in the consulting industry have now got record levels of dry powder or capital available to spend on new acquisition opportunities, which is what we're trying to demonstrate in the bar chart to the left of the slide. And as such, as we can see on the right-hand side of the slide, despite a lot of the competition that these private equity investors are facing from those aggressively acquisitive listed strategic players that we discussed earlier, they are maintaining strong levels of activity in the consulting sector. Roughly about 10% of deals, which varies a lot depending on the size of acquisition. Now, as a consulting owner, understanding both of these buyer groups, what they're looking for, how they're going to approach a transaction, will really put you in the best position when you're choosing the right partner to help you achieve your exit goals. As we can see from the summary table, both buyer groups will vary in what they offer you as a seller and how they go about evaluating your business, how they approach structuring a transaction, how they approach the due diligence process once they've made an offer for your business that you've accepted, and also what they do with your business post-closing of the deal. So it's very important to getting a good understanding of all these different aspects of a buyer and how they'll behave when you're trying to choose the right partner for your firm. Now, as a word of caution at this stage, I think it's just worth noting that we're going to be talking about typical characteristics of each buyer group. But remember that all buyers can't neatly be categorized into these two buckets. For example, you might have a strategic buyer that approaches you and it will be acting like a financial buyer in how they go about investing in your company. Or more likely, you might get approached by a private equity buyer that already has an existing portfolio business for which they're looking for an add-on or bolt-on acquisition. Where that's the case, they'll be approaching the deal more from the angle of a typical strategic player. Now, before we move on to the next slide, I just wanted to run a brief poll amongst everybody and really ask you the question, which of the following characteristics will be most important to you when considering your perfect buyer? So the options here are, which hopefully will pop up on your screen: cultural fit, ability to take your services to new markets or geographies, commitment to keeping your brand, the ability of a buyer to provide career opportunities and back office support to your team, or the buyer's ability to give you capital available to invest in the growth of your business. So I'll just give you a bit of time to have a think about which of those aspects would be most important to you when you're considering the best buyer for your business, and we can just discuss the results of that in a minute.
Hi there. I think we've got a bit of a sound issue, so you'll be able to see the results on screen. Ramon, can you hear me?
I can hear you, Sophia.
Perfect. So we finished running the poll, and you should all now be able to see your quick results. So we've got cultural fit at 42%, ability to take my services to new markets, geographies at 16. No one voted for commitment to keeping my brand. 11% for ability to provide career opportunities and back office support, and 32% for capital available to invest in my business. So I'll pass back over to Ramon to let him discuss those results.
Yep, yep. Well, the top result there, cultural fit. I think that's a very important, important thing that comes up in a lot of our deals. And where you're dealing with a strategic buyer, a lot of the diligence process, a lot of the meetings that you're going to be having with the buyer will be assessing on both ends whether you see that cultural fit making sense. And ultimately that's going to better improve collaboration and joint working, which is going to enable a lot of those synergies for the strategic buyer. Now, on the other side of it, the benefit of a private equity acquirer is that you'll be retaining your own brand, you'll be operating independently. So the cultural fit between the two firms, possibly won't be as important as it would be with looking at a strategic acquirer as a home for your business. But I think that poll really was a useful exercise just to get everyone thinking about those aspects of a buyer's proposition or offering that are important to you as a consulting owner when considering a sale of your business. So from a private equity buyer, you would typically expect to be offered the opportunity to enter new markets or geographies as part of their growth plan. And one of the benefits of a private equity buyer in that respect is that they will provide you with strategic advice, market access through relationships to help you achieve that market penetration as part of a growth plan that they set out with you. And you'll normally also be offered the opportunity to retain your brand and culture as you're remaining an independent operating business, owned by the private equity fund. Also, a private equity owner will typically offer you flexible ownership options. So that would go all the way from offering you a minority investment in the firm, all the way through to a majority buyout, where in both cases you'll be expected to retain some equity in your business, which will align the incentives, which will really align your incentives with the incentives of the private equity firm that's investing in your company. And the benefit of that equity investment is it's going to offer you a second bite of the apple, so to say, and really with further upside potential when the private equity owner looks to exit their investment after their hold period, and you can then sell your equity at a substantial return, hopefully, when you get to that exit point. From a strategic buyer perspective, they're typically going to offer you immediate synergy opportunities from cross-selling. So, thinking of an example of, your business possibly being acquired by an accounting firm, there'll be immediate opportunities for you to cross-sell a broader set of professional services to your clients, and also to offer your services to their clients, and possibly win new larger clients that are looking for a one-stop shop and a larger global advisory platform. A strategic buyer will also typically offer you benefits for your staff from a career development perspective. And looking at a lot of our experiences with clients, we've got a lot of really good examples of clients that have been sold to strategic buyers and then have progressed rapidly within these organizations to take senior positions. And that's also occurred for a lot of their team members as well. And finally, a strategic buyer could also offer you access to more back office support and infrastructure, which will really can be used as a platform to grow your business and take it to the next stage in its growth. Now, flipping this over, how will each of these buyer groups differ in how they evaluate your business? Both buyer groups will be using a blend of quantitative and qualitative metrics to evaluate your company as an acquisition opportunity. But what we typically observe is that private equities are more focused on quantitative metrics, like assessing your profit margins and your growth rates historically, and then using that to form projections which will then go into their returns models, and can be used to assess the ability to generate cash within your business, which can possibly be used to raise debt capital to fund the acquisition and boost their equity returns. Strategic buyers will tend to be more focused on qualitative metrics, things like cultural fit, assessing your client base, assessing their ability to cross-sell services into your clients, also assessing your intellectual property and the ability to scale that within their own organization. So the emphasis, will be placed on those qualitative aspects of your business from the strategic acquirer, but both will be using a blend of quantitative and qualitative metrics to assess your company. And our latest buyer research indicated that private equity buyers have higher KPI thresholds when they're assessing acquisition opportunities as compared with strategic buyers. So what you can see in the bottom left-hand corner of this slide is that the private equity firms are targeting higher growth rates, higher gross margins, revenue per employee, and utilization rates as compared with the strategic buyers. And also what came out of our buyer research is that from a qualitative metric standpoint, a lot more emphasis was placed on intellectual property by private equity firms. Specifically, a lot of importance was placed on software as a type of IP. And ultimately, strong intellectual property, strong software tools, de-risks a lot of the dependency of the value of your business on retaining people. So that is valuable to a private equity firm in considering the risk of your company in comparison to another business which is solely dependent on maintaining its workforce. Now, before we move on to the next slide, I just want to run one final poll with everyone. I just want to run through what aspects of an offer for your business you would find most valuable. So the options here are cash up front and earnouts linked to future performance, or equity in a larger firm, or a blend of cash and some retained equity in your business, salary and title position uplifts, and finally a commitment by a buyer to execute quickly. Which of those would you find most valuable within an offer for your company?
So we've got the results back up on screen. So 44% said cash up front and earnouts linked to future performance. 0% for equity in a larger firm. 44% a blend of cash and some retained equity in my business. 0% for salary and title, position uplift. And 11% said commitment by the buyer to execute quickly. So I'll just pass that back over to Ramone to discuss.
Okay, great stuff. Well, I think think these results, again, will dovetail quite well with the next section of the webinar. Cash upfront and earnouts, typically we see that being offered by strategic buyers. The blend of cash and some retained equity in your business, that's something that's typically offered by private equity firms. But hopefully again got everyone thinking about how you might be looking for certain aspects of a deal structure, and considering that in the context of selling your business. Before we get on to deal structure specifically, I just want to discuss differences in pricing between the two buyer groups. The difference in pricing between a private equity buyer and a strategic buyer varies a lot depending on the business cycle and also the type of transaction that is being considered. In current market conditions, though, there shouldn't really be any significant differences between the pricing of a private equity and a strategic buyer. Strategic buyers are able to generate revenue synergies, and they're able to share a portion of that value with a seller to make their bids competitive. But also at the same time, private equity buyers typically have rapid value creation plans. They're also looking to raise debt capital, and also, as we saw earlier, they're sitting on large pools of dry powder, which they're under pressure from their investors to deploy in new acquisition opportunities. So all of that is enabling them to price at very similar levels to strategic buyers for acquisitions they want to do. And as we can see from this table here, taken from our buyer research, in fact, a lot of the private equities that we surveyed had higher valuation expectations and valuation targets as compared with strategic buyers that we surveyed as part of last year's buyer research report. Now, although pricing in the current climate doesn't need to be materially different between each buyer group, strategic buyers will tend to structure deals differently to private equity firms. So with a strategic buyer, you'll tend to see them structuring deals with which are majority buyouts. It's very rare, but it does occur in some instances where they will take a minority investment in a company. But normally a majority buyout is what we'll see. They'll also typically structure the deal from earnings that they're generating within the company. They're not typically using debt capital to fund their acquisitions. And they will typically structure a deal with a combination of cash up front, some fixed deferred payments, and an earnout linked to future performance, normally lasting 2 to 3 years. So for those of you that answered, that as being important for your business, that's, those strategic buyers are the ones that will be offering you that as part of their deal structure. Private equity buyers, on the other hand, will typically structure a deal with more flexible funding options. So that might include a minority investment all the way through to a majority recapitalization. But in both those instances, they will expect you to have some equity retained in the business. And the benefit there is that you're getting that second bite of the apple. And for an entrepreneurial management team that wants to remain with the business, it provides you with that potential further upside when they look to exit the business later on. And that's opposed to those owners looking for that definitive exit from their business within a shorter time period. There, the strategic buyer is more likely to be the better home for your company and provide you with a better option. So assuming that you get an offer from either buyer and you accept that offer, the next phase in the sale process is that you will be undertaking due diligence. So the buyer will be due diligencing your firm and will be undertaking that prior to closing the transaction. And at this phase in the transaction, each type of buyer will again differ in how they're approaching the due diligence process. And a lot of this will depend on the type of a transaction, but there is a potential for certain buyer groups to be more efficient and to complete their due diligence more quickly than other buyers. So a strategic buyer might have the ability to move more quickly through diligence if they have a lot of experience in doing deals. If they have their own M&A team, for example, and they have a very disciplined approach to completing transactions, that will enable them to get through the process quickly. There are also benefits, more than likely, just from having that prior knowledge of your company's services and the industry. So they'll be able to get their head around the company and the market potential possibly more quickly than a private equity firm. But one of the restraining factors for a strategic buyer during the diligence process will be the potential for regulatory issues. And here I'm really thinking about accounting networks that might need to spend a lot of time considering the audit restrictions that will occur if you provide your services to their audit clients, and what that will mean for the business plan. So that that might take a big chunk of the diligence process and really extend out the timing for them if those issues do materialize during a transaction. Private equity buyers, on the other hand, may have the upper hand on a strategic firm if they've done a lot of deals before, and the strategic buyer takes a bit more of a selective approach to deal doing. Private equity firms are experienced in completing transactions. They will typically have a very disciplined approach to diligence, but at the same time, they will take additional time on diligencing the industry. And we come across examples in our own experience of private equity investors sometimes hiring a commercial diligence advisor to really get under the bonnet of the industry and the company to really better understand the market fundamentals, and spending a lot more time understanding that as part of the diligence process. They're also going to be restrained by the time required for raising debt if they're looking to do that as part of a transaction. So that really could mean that they take a lot longer than a strategic buyer to do a deal, because they're spending a lot more time working with the banks to diligence the cash flows and the earnings potential of the opportunity. So during the diligence process, a lot of things here to think about when it comes to how both buyers might be approaching a review of your company and diligencing it. After diligence and after the transaction is completed, we then move on to post-deal considerations, and we touched on a lot of these at the beginning of the webinar when we spoke about the typical opportunities that each buyer will present you. But after completing diligence and finalizing the transaction, if you've gone down the route of selling your business to a strategic buyer, the focus really here will be on integrating your company with the buyer's operations and enabling those synergies that the strategic buyer are looking for. And more than likely, a lot of that will be linked to those earnouts that you'll be getting over that 2 to 3 year period after the closing of the transaction. Or if you've gone down the private equity route, at this point you'll be focusing on partnering with the private equity firm on driving growth, looking at where to invest growth capital within your business, and ultimately looking at how you're going to deliver that profitable exit for yourself and the private equity partner after the investment hold period. So a lot of these things you should be thinking about upfront on how you feel about these outcomes for your firm and yourself after you've closed a deal with either private equity or a strategic buyer, and how that really influences your decision to go with either party. Now finally, just finishing off with some real-life examples, we wanted to highlight 2 transactions that we have recently worked on. The first one at the beginning of last year was the sale of CouncilWorks, a financial services focused regulatory compliance business that we sold to Duff & Phelps. The owner of that business was Rosemary Finelli, and she had a number of options on the table. One was obviously Duff and Phelps, and another was actually a private equity-backed offer. Ultimately, it was the opportunity to be part of this growing organization with a global platform, which was looking to penetrate the US regulatory compliance market that really won it for Rosemary. And the deal has been very successful for her and her team. She's now moved on to become the global chief regulatory strategist for Duff and Phelps globally. And many of her staff have also grown within the business, so they've all done very well out of a transaction, and ultimately taking that strategic route was the right decision for this client. We also sold a business last year called HS2, which is a digital consulting firm to a mid-market private equity investor called Mountain Gate Capital. Here there were a variety of offers on the table, and again, a mixture of some strategics and some private equity offers. But for HS2, it was really about retaining their independence, their brand, and their ability to gain that further upside after working with Mountain Gate to grow their business and expand it further. So here, for this team, it was really the private equity route, which was the best option for taking their business to the next stage. Great, so that ends our webinar. So I'll hand back to Sophie for any questions that the audience has.
Thanks, Ramone. So first question we've had through is, if I want to keep my business and grow, what other options do I have to raise financing?
Great, thanks for that. Private equity is the predominant method for raising finance for control deals, but the other two options that businesses will go down for raising finance will be raising debt capital or undertaking an initial public offering, an IPO of a business. Now, an IPO involves floating your company onto the stock market, and it gives you an option of raising some more capital and taking some money off the table. But typically, what we see in the professional services market is that this option really is for companies that are a lot bigger than a lot of the clients that we work with, and typically faster growing businesses. So in this circumstance, really, it's not really the best option for a lot of the clients that we're working with. They're typically going to be acquired before they are at the stage where they're going to see an IPO as being a sensible option for the business. And also, I think the other thing to think about with an IPO is that that option is very cyclical. It's very dependent on the state of the stock market. At the moment we are we're approaching record highs for consulting share prices, but in a down market, that option then becomes less positive for an owner of a larger consulting firm. And just on raising debt, I think it's just worth noting that the issues that some of the consulting firms have with going down that route is a lot of the generalist lenders will want to see hard assets in your business that they can lend against, and in the consulting industry, then it becomes a bit more difficult for some of these generalists to lend to firms that we come across. If you're wanting to go down that route, it's really finding a specialist lender that is used to working with project-based businesses and has possibly lent to consulting firms in the past. And then if you find a lender like that, then it might become a decent option for raising some capital to grow your business and take a bit of money off the table as well at the same time.
Okay, thanks for that, Ramone. So just taking a look here. Staying on the finance theme, I think. is it possible to get a minority investment from a trade buyer? And would there be any benefits to doing that?
Yep. So I think we mentioned earlier that, typically it's private equity firms that are taking that minority investment in consulting businesses. But there are enough examples that we've come across where, some of the larger trade buyers take a minority stake in a company, really with the view of eventually looking to make a full acquisition. And, the benefit from the buyer's perspective here is that they get a little bit of control without that risk of fully acquiring your business, and they can use that period to test an acquisition. Now, I think that also has benefits for owners of consulting firms. They can test the deal and partner with a potential acquirer before going ahead with a full transaction, while also getting a bit of growth capital that they can use to expand their company. But I think the clear disadvantage that we advise our clients on is really that it limits your options. If a strategic buyer does make a minority investment in your company, they have a seat at the table. They're able to steer you towards, the eventual transaction with them as a buyer, which really limits your flexibility in considering other opportunities that are out there.
Okay, thanks for that. Couple more. So you talked about tailoring marketing materials to certain buyer groups. Can you expand a bit more about that, on that?
Yep. So when we talk about tailoring marketing materials, it's really about focusing the messages of your IM or your information memorandum to the needs of a respective buyer. So when you're thinking about a strategic buyer, a lot of those messages should be focused on what are the synergy opportunities that are available to them, what are the strength of your client relationships, so they can think about cross-selling their services to those clients, talking about your intellectual property and the potential for scaling it within a larger organization. And also, there's a lot of opportunity there to even do a bit of modeling around different synergy scenarios, and we do a lot of that in our marketing materials when we're going out to strategic players, and that really plants a lot of these synergy ideas into the minds of a buyer when they're reading your IM, and getting an idea of all those potential opportunities for them if they're the acquirer of your business. And then with a private equity firm, the tailoring there might be more around getting into a bit more detail on the market itself, given that they might not have invested in your space before, and giving them a bit more detail on your services if they need to get a bit more information on that because they haven't dealt with companies in that space previously. And then also, with a private equity, it's a lot about standalone growth and the opportunities that will arise if your firm gets growth capital. So, talking about the opportunities that you see out there, and you really want to take advantage of if you got growth capital invested into your company. And then, I think also with a private equity firm, it's talking about and this might not be through the marketing material, it also might be through the management meeting. It's talking about your entrepreneurial drive, your desire to grow the business so that the private equity partner can see that you're hungry to take the business to the next level as part of their investment.
Okay, thanks for that, Ramone. So I think we've got time for one more question. I'm going to, we'll pick this one. So I have a lot of loyal, long-term serving staff. Will they be protected if I sell to a strategic buyer?
Yep. So that's a good question. I think when it comes down to transactions in our space, strategic buyers are looking to acquire capability. So it's not in their interest to be getting rid of client-facing staff. They're acquiring these businesses to gain this capability and to keep hold and retain these people. So I think ultimately, from a strategic buyer and even a private equity buyer's perspective, they will be looking to retain capability, retain a lot of those front client-facing staff. Now, with respect to non-core functions or overheads, there might be an argument for a strategic buyer to look to normalize some of those functions because they become redundant within their larger organization. But I think it's worth noting that in our experience of dealing with these sorts of transactions, we typically see minimal redundancies. There's typically always an opportunity to move people within the organization. And these companies are typically acquiring because they're growing. So the risk of losing loyal staff, I think, is something that we typically see as being quite low in our space.
Okay, thanks for that, Ramone. So I think we've kind of hit our limit. I know a few people have asked some very in-depth questions, which I think, Ramone, it's best if he comes back to you and he goes into a bit more detail for you. If anyone else does have any more questions, please just drop me a line. My email address is sophie.lewis@equitech.com, and I'll be able to put you in touch with Ramone and he'll be able to answer anything you need. Also, if you're not already a member, just to remind you, we've got our Equitech Edge Club. It's a free source of information for consulting firm owners like yourselves, and it's got links to our blog, unique articles, all our publications that are available to download, links to all our previous webinars, so please do join up. Just to make you aware, we should soon be launching our latest version of our buyer's research report. So that should be coming out soon. I will also be running a webinar on that on the 12th of December. So I will add that into your post-webinar follow-up link and give you that link to register. Recording of this webinar will be sent to you as well in that email. And if you'd like the slides, I know some of you have asked for them, I will be sending those out. So please do get in touch if there's anything else we can help with. And thanks to Ramone for presenting, and thanks everyone for dialing in today.